Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Hello, everyone. Thank you so much for joining us today. My name is Kelly Gonsalves. I am an accountant based in New York City. My firm is called Totally Booked. I've been in a business for about 10 years now. And throughout that 10 years, I've had the pleasure of meeting Dan Gertrudes in person. And so this is very exciting that we get to do a webinar together to discuss his firm and how he had pivoted to advisory and FP&A and all of the fun things. So Dan, please introduce yourself.
Well, you know the pleasure's all mine, Kelly. I didn't get to see you this year at the big conferences.
Yeah.
Thanks, Kelly. And thanks to G-Accon. I'm Dan Gertrudes, and I also have one of my colleagues, Ryan Clifford. I'll let Ryan introduce himself, but he essentially is our FP&A manager and the firm's own CFO. So I'm Dan Gertrudes. I started GrowthLab probably about 12 years ago now. Back then, it was me, myself, and I was doing fractional CFO work. And, I realized because I'm not an accountant, I didn't really know the whole debits and credits thing and the QuickBooks, Xero. And so we actually started our journey as an accounting firm by doing our first acquisition back in 2014, 2015. And it's been a wild ride. From the onset, like advisory, FP&A was always part of our DNA. Partly because of the customer base we had, Kelly. Like we were doing a lot of venture-backed startups, so things like a 3-5 year business model, financial model was very sort of core to a startup's success or being successful in raising capital and grounding that story for investors. And so over the years, we built out that whole value stream from accounting, finance. We even started a tax side of the business right in the middle of the start of COVID 2020. We also have an HR service as part. And many folks know us also for another company we have, which is called Streams. We develop, deploy, and maintain AI automations for finance and accounting teams, not just advisory firms, but also small, medium-sized businesses. So I'll pass the baton to Ryan. Ryan, feel free to introduce yourself.
I'm Ryan Clifford. I've been with GrowthLab for just a little over 4 years now. Started as an analyst and learned the ropes from Dan. He's taught me so much. And now manager of the team with 2 other analysts.
Nice. Did you go to school for this, Ryan, or did you just decide that you kind of just happened upon it?
I didn't go to school necessarily for this. Kind of happened upon it, but it was a good fit.
Nice. Me too. That's why I asked. I didn't go to school for this. I just kind of happened into it. And so I was curious to see if that was your chosen path, because Dan is like, we started this way. This is what we're doing. So I was curious to see if it was the same for you.
Yeah, definitely similar. And like I said, Dan's taught me so much, so didn't really need it from school. So.
All right, you're going to get that promotion. One of the things that's, by the way, somebody's saying that there's an echo, and I just checked my settings, so I'm not sure who solved. Okay, good. That's good. One of the key things that I usually talk about when I talk about like building an advisory side to the business, it actually also starts with the people, right? And so one of the things I think you just heard from Ryan is that he's actually not an accountant.
Right.
Like, he's a financial analyst, and it's core to that DNA of accountants. Like, the balance sheet has to balance, and yes, in finance, of course, the balance sheet has to balance. But here's the big difference. In accounting, it tends to be very discrete. It's a debit and a credit. In finance, it's very gray. So how you build the team is also going to be key to success in building an advisory practice.
Okay. Interesting. Okay.
Oh, and I controlled the slides, so I was.
Yes, you do. Yes.
So today we're going to be talking about how to go from accounting to advisory, especially as AI is knocking at our doors, if not already in our house. So we talk a little bit about who we are. Our mission is pretty straightforward and simple. It's elevating and empowering our people and our customers who are also people. We're going to touch on value-based pricing, because one of the things that I quickly kind of got a bad taste in my mouth 12 years ago was this feeling, this notion of like the billable hour. I felt like a mercenary. I was selling my time. Mm-hmm. Now, prior to that, I was like, I was a corporate person, right? So I always had that paycheck every Friday, which was very different when you start a business and you become a little more entrepreneurial. Like, you'll take whatever you can get, right?
Right.
In the beginning, like, we can all talk about how bad the billable hour is, and we should be moving to fixed price and value-based pricing. But that in of itself is also a journey, especially when you buy into this industry, right? When you buy a company, you're taking the good, the bad, the ugly. And if you try to take the ugly and convert it into something better, it doesn't happen overnight.
What?
It's a journey.
I can't believe that.
Oh, yeah.
I would just wake up like Cinderella and it's just all done.
Trying to convince customers who have been paying for bookkeeping by the hour for the last 10 years. It's a journey. So give yourself some grace as you enter that part of the journey. And then the third piece is people first. Like I mentioned with Ryan, like, we decided as we were building out the advisory side of our business, specifically the FP&A and the virtual CFO, it was sort of very uncomfortable for accountants to be in that mold. And that's okay. Part of this is it's choice, right? And so at least for us, if an accountant didn't want to be an advisor, didn't want to move into that CFO role, we can still elevate our accounting team to be more advisory, but we don't have to put our accounting team in a place where it's very uncomfortable to be building out 5-year financial forecasts.
Right.
We believe that our team is a differentiator.
I agree. I would hope that most farm owners agree with that. People make a huge difference.
Right? Oh, totally. And so why add advisory services? Well, the accounting piece of what we do is so critical. It is believe it or not, it is actually really difficult to be an effective CFO or to provide effective advisory services without having solid accounting. So stop there, right? To get up to bat, you need that accounting.
Yeah, I was talking to somebody about that yesterday, and a big part of it is, I think we all agree, financial advisors, CPAs, bookkeepers, EAs, et cetera, in the space, that none of this works if you don't have clean books. Like,
Agreed.
You have to have your numbers. You have to have I'm not saying you have to have a decent understanding, because I know for the business owner, it's not always something easy to understand, but the reports have to be clean. The information has to be clean, because forecasting on made up numbers essentially is not going to get you very far.
Especially in the world of accrual accounting, which has a completely different complexity to forecasting. So we all know what the purpose here is, right? The first three, I think most of us have heard it over the last 5-6 years. The deeper customer client relationships, being that strategic partner to create greater stickiness, predictable recurring revenue. That's what I love about this industry.
Yeah.
That's what I love about this industry. Why? Because as any business owner knows, we don't have a crystal ball, but being able to foreshadow what our revenue is or will be helps us build out the resources we need to render that revenue. But it's the fourth one that I'm most passionate about now, because I believe that AI is a double-edged sword in this industry.
Okay.
AI will create tailwinds, but it will also create headwinds in this industry. And those headwinds could make the accounting piece of what we do a little less stickier, a little less valuable. And by offering advisory services, you're essentially hedging your bets without being able to really know what the future holds. With AI and accounting, I believe that advisory services, providing fractional CFO services, FP&A services, even tax advisory and strategy services will be a big differentiator in the coming years.
So with AI in the space now, realistically, right? We know it's in the space, it's inside of our softwares, it's inside of the accounting softwares and the additional apps and everything that we use. Where are you seeing, or what are you seeing is the biggest catalyst to pushing firms to making that jump to advisory? Do you think, it sounds like you believe that it is the differentiator between just being the bot? Is that what it is?
I believe it is. And for those of you that dust off the old book, Innovator's Dilemma, it pretty much lays out what that journey might look like here in the accounting space with the impact of AI. Now, AI is also a great tailwind in this industry because it allows advisory services to be more efficient. In other words, and I'm going to talk a little bit about the 80-20 rule when we're scoping out these services in the later slides. But what it does is, I always think about it this way. My goal is to, of the 80% of the revenue we receive from a customer for advisory services, the goal is to only be able to allocate 20% of those resources, the value of those resources. And AI is going to continue to make us more efficient. Not just AI, but tools like G-Accon. One of the reasons why we're able to scope out our services, and I'll talk a little bit again about cadence and people and the rigor, these tools make us more efficient and allow us to maintain and identify scope creep. It allows us to scale. It's another service-based business. It's a human capital like service-based business. It allows us to also effectively scale this business model inside of our firm.
Okay. What do you think is holding people back from making the jump to advisory?
Oh, so here's that's a great question segue.
Okay.
Kelly and I,
perfect.
we practiced like 2 or 3 hours on this one.
Oh no, we only have 50 minutes. Okay, go ahead.
It's a journey, and I lean into that journey. All too often, I know we sit in some of these webinars and folks tell you, just do it. Just flip the switch. It's not. I've been at this for 12 years, and we're not perfect. And Ryan can attest to that. I believe that in a service-based business, people are more comfortable in a reactive mode than in a proactive mode. It's easier to talk to a lawyer. Like, you talk to a lawyer, what do? They sit by the phone and wait for the customer to call. versus picking up the phone and calling the customer and saying, hey, how's it going? Are we doing any transactions this quarter? Do you have any potential litigations coming your way? Do you have any employment compliance challenges? It's
Right.
easier to just sit and wait for the phone to ring and then just charge your client by the hour.
That's true. But
Now,
I would say the benefits and the outcomes, what you described in the previous slide, would, I would say, dispute some of that.
correct. That's why we're on this journey, for sure, right? I believe that being proactive in advisory services allows you to set the tone, allows you to bring a prescribed approach to delivering advisory services. At least 80% of what we do can be prescribed. It can be scoped, giving us 20% to focus on some of the ad hoc stuff. Maybe a little extra love and customer hospitality in that 20%. But to do that from the lens of a billable hour versus value-based pricing or fixed pricing, chances are the customer is not willing to pay you by the hour to pick up the phone proactively and say, hey, how's it going, Kelly? How's that
I would
going?
say, especially in our industry, clients are probably a little more scared if they hear from you when they don't think they're going to, because with the billable hour in place, it can be off-putting. I had a call last week. Somebody had their CPA on the call and they had mentioned, like, I have to pay for this time. And so let's keep it, succinct. And I was like, oh, I moved away from that probably 8 years ago. And so it's still out there. And so I think it is something that scares customers away sometimes, clients, right? And they're hesitant to call you and so also then they wind up making bad decisions sometimes, but they're hesitant to call you for advice if they're worried about getting the bill after.
Yeah, I believe it's human nature.
Yeah.
Right. The other part of our journey was people as a differentiator, and leveraging not just like the team's expertise, but like what makes up the DNA of that employee. And trying, the square peg round hole is so common with employees. Putting them in an environment, in a place where they're not comfortable, where they're not leaning into their strengths, where they're not bringing their best to the table. And so one of the things that we decided was, when we hire for advisory services, we were not always looking for a CPA or an accountant or a bookkeeper. It's not to say that we haven't had success in promoting people with an accounting background, but leading in with what are the attributes, the capabilities, that DNA that we need in that role. And then the last piece in the journey, which you rewind 12 years ago, it was like spreadsheet jockeying. It was version control. It was broken formulas. It was the accountants adding a new chart of account without telling the financial, the advisory team, like, oh yeah, I added another chart of account. And that's why we love tools like G-Accon, because what happens in the general ledger, it's a lot easier to capture in your financial models. So technology augmentation makes it more efficient, so you're not looking for that needle in the haystack in the middle of the next month.
Yes.
So the second part of this conversation, and I guess I should have given everybody.
Can I stop for a second, just because it's on the slide and I know what it means, but can you explain what GrowthLab and specifically your finance as a service means?
Sure. And maybe it came from my background. I never thought I was going to, like in a million years, I never thought I would be working in or running or owning an accounting firm.
Okay.
So it never jived with me. And 12 years ago, I coming out of corporate with a corporate finance and M&A background, I kind of saw this as, hey, we're not just selling bookkeeping or we're not just selling tax. We're approaching the market with the entire value stream under that accounting and finance, sort of that CFO suite. So for us, the service we were providing, and we've expanded beyond just finance with HR and AI automations, it was really providing on a fractional basis, scoped out, fixed price, financial needs for small, medium-sized businesses and startups.
Oh, thank you. It was right there, and I felt like everyone needed to understand that.
And so one of the things I probably failed in this presentation was to give everybody an agenda. And so section 1 we just went over. This is going to be section 2, and this is sort of like I'm going to call it our secret sauce. But we're not perfect, right? I'm not going to sit here and like what we do is super tight. And then section 3, because many times in these webinars, it is a lot of talking and a lot of telling people how to do things. We're actually going to show you, Ryan is actually going to do a very simple demo of G-Accon in, I believe he's going to be using Google Sheets.
Yep.
Okay. So when we think about, well, at least when I thought about how do I provide advisory services, and not reactive advisory services where we're waiting by the phone for a customer to call us and say, hey, I'm about to do this, I need help. We wanted to be able to say, okay, what are the things that happen throughout the year that we can say, we can leverage our team, our services to help customers stay on that annual strategic business cycle.
Okay.
And the first one is the annual planning. Now, annual planning is our annual operating plan. We also have a long-range plan, which I'll talk about later. But every business needs an annual operating plan. That is the budget that's fixed in stone going into that fiscal year. And everything kind of happens from that budget. Hiring decisions, capital, liquidity planning, capital expenditures, new markets, etc. So that's the plan that we start the year with. But here's the problem. Any of us on this webinar can probably put together an annual operating plan, a budget. We probably do it for our own firms, hopefully. Well, back in the day when we weren't so virtual, 99% of those plans ended up in the top right-hand drawer of a desk, never to see the light of day.
Sure.
Until maybe December 31st when somebody was like, oh, I wonder how we did.
I wonder how we did.
So what we wanted to do was sort of operationalize, systematize advisory into a monthly plan, into a monthly service, so that we're checking in with the customer on a monthly basis. And those are our monthly outcomes. So every month, as part of our advisory service, and I'll get into more detail, but just high-level framework, you start the year with your annual operating plan, call that your budget, fixed in stone, and then every month, we're doing something with that budget, and we're doing something with the great work from the accounting side, the actuals. And we're reviewing that on a regular cadence, a cadence set in stone.
Okay.
The third part about the annual strategic business cycle is bridging the functions. So here's what normally happens, right? You create this annual operating plan. One, you probably didn't even ask your direct reports or department heads to provide input. Maybe you're a small business, you're running a coffee shop. It's not like it's not so sophisticated, right? It tends to be very flat management. Maybe we're not looking at different revenue SKUs. We're not looking at our costs a little more granular, operating expenses, etc. So what this allows us to do is to bring the budget, provide feedback loops to the different teams or departments, and then doing this on a monthly basis rigorously.
Okay. So the whole team stays involved.
The whole team stays involved because here's the workflow, right? So here's how we scope it out. If you were to look at our engagement agreements for, say, FP&A, it would be very detailed in terms of meetings, outcomes, and responsibilities from the customer. And I know one of the questions is like, how do you get the customer to show up? How do you even get them to commit? Well, if they can't commit, it's probably not a good service for them. They're not ready for it. They're either not mentally ready, they're not positioned for it, because what you'll see is our cadence is the accounting close call it the 15th of the month, of the following month, and the FP&A calls, meetings, are staggered around that accounting close call. So at the beginning of the month, we have what's our operations calls. And I'll kind of talk to you about what's in those. We have our ops call, we have our accounting close call, and then we have our finance call. So defining those workflows in the engagement agreements is important. 2, drawing that clear line between the annual operating plan and the long range plan. Annual operating plan is the plan for the current year or the following year, which usually gets, we start compiling that between now and January 31st. The long range plan is, it's a lot grayer. It's 3-5 years outlook, and it takes into consideration things like liquidity planning, capital raising. You can't just wake up one day and say, oh, I need a $1 million line of credit. Like, there's a lot that needs to go into that. And then be able to have the conversations with bankers or investors and be able to show, like, not just historicals, but how you're thinking about where you are today and how that extrapolates out. And then the third piece is we always have 3 sets of numbers. Not one. It's not just what's in your QuickBooks or your Xero. The actuals are very important. But the other 2 sets of numbers that we always have is your budget, that's your AOP. And the third set of numbers is your updated monthly forecast. Every month, you're updating 12 months out your cash flow forecast. And with that baseline, with those 3 sets of numbers, now you can start to see how these 2 meetings, the ops call and the finance call, come into play.
How do you get them to stay in their lane on each call? Because I feel like, sorry, and I'll back that up a little. So oftentimes I hear that when people are trying to move into advisory, they get on a call with their client and it's immediately like, oh, I have to get you that document. Oh, this was in QuickBooks. Oh, and it kind of turns into more of a bookkeeping, accounting catch-up call. And so is it different people, different teams? Is that how you kind of keep it? Or if it is just a smaller firm, how do you keep them in line to not kind of veer back into what they're comfortable with? Good question. So here's the cadence, and here's kind of like, and I'll walk you through like how we keep the call on the rails. Okay. Again, it's the 80-20 rule. 80% of what we do has to be prescribed in order for us to make money and not, and not go back to the dreaded billable hour. Right. Let's start with the ops call. Well, I'm actually going to start with the accounting close call because that's actually where it all starts. It just happens to be in the middle of the month. Yeah, I was going to say. Right? But if you were to look at a month, the interactions you have with a business within the month, yeah, it is the ops call that starts the month, but it's not the ops call that starts the process. It's the accounting close call. So you let the accountants finish the work, close the books. The next call, and that can be maybe a week later, the next call is what we refer to as the finance call. How do you keep your customer on the rails when we're talking about the finance call? You start the meeting with, how did it go with the accounting close calls? The accountant told me that this accrual was off prior month.
The accountant mentioned that you pulled in a big purchase or revenue that you expected, right? Having 5 minutes, catch up on how did the accounting close call go. 2, jump right to budget to actuals. So here we're looking at what was our AOP versus our actuals. And guess what? It's always going to be wrong. It's always going to be off. There's going to be variances because what you thought in November coming into the year and you're in the middle of July, it's going to be off. But that's okay that it's off because now you have that second set of numbers, which were June's updated forecast. Let's pretend we're in July. You have June's updated forecast. And now you're in the middle of, at the end of July, and you're looking at what did I say I was going to do in June in my updated forecast versus what I actually did. And those variances, and here's the beauty, we want to talk about AI. Like this is where AI helps us move a little faster. You start feeding, like we've connected our Chat GPT, one of our team accounts, to our QuickBooks.
Okay.
And so it tells us what the variances were. It says, hey, there was a big variance in this revenue skew between what was actually recognized versus what we were thinking last month.
Okay.
Why? That's going to be that's the biggest takeaway out of the finance call. Why was there a variance? And it's, again, you're not going to go through all the variances. You're looking for magnitude, right? You're looking for big changes of what was expected versus what we experienced. And that's where those whys that come out of that, those are the risks and opportunities that we identify based on those variances. You'd be surprised how quickly you can get through a finance call, like 45 minutes in, focusing on those variances. Because now those variances, folks, is going to feed the ops call. Going into the ops call, the goal of the ops call is to update the forecast for the next month. And that's where you look back at what are the drivers of your plan, the hiring, the cash spend, revenue, and then you roll that forward 12 months.
Okay.
So I know it's a lot, but that accounting close call leads to finance call that leads to ops call, and that's where the three sets of books.
So you mentioned that if clients are resistant to it, they may not be your client, which I can understand. But how can you tell if it is resistance or maybe fear, something where they might be a fit, but they're not totally sure, I don't have time for these calls, or I'm not, so how do you tell? Because I think sometimes clients are like, whoa, but they're not necessarily a bad fit, that they're just a little scared of actually getting
They're not ready. Yeah.
They're not ready. Okay.
They're not ready. And so one of the ways we get around that is by, talking about pricing. The next slide, talk about this. Here's our matrix. And I forgot to put our pricing on there, but it's on our website. For those businesses that are not ready for that real rigor and that cadence and dedicating the time, we offer the light plan. It's a quick and easy way of just drawing up an AOP. You put together some dashboards. Maybe you have a review, and the review is a little less formal, or even maybe like Ryan's team will just show up at the accounting close call just to review some of these numbers. Maybe we charge $500 to $1,000 for the light. But that's not a heavy lift, right? Now, what does that do? It allows Ryan's team to get in front of the customer and interject at certain points during the accounting close call. And then the customer's like, oh, man, maybe I need a little bit more planning. Maybe I need to take this stuff a little more serious. And we're like, no kidding. You do. And so the light for us is sort of like the freemium. Let's just get in there and see.
The intro. The intro. Dip your toe.
because the business owners, the managers, they're already used to the accounting close call. They should be though, right? And that's where then from the level 1, level 2, it just comes down to the level of sophistication in the modeling. The more reporting, department level reporting, that just requires a little more hand holding. And so that's where the price differential begins to pop. I think level 1 is at 2,000, level 2 is at 2,500 to 3,000. And then back to that 80%, this is where we start offering virtual CFO services, because if we're meeting the needs at the 80%, the tactical needs, but they need a little bit more financial acumen, strategic acumen, some more elevated strategic partner maybe, that's where the virtual CFO comes in. Now, the virtual CFO, if you were to pay a CFO to do the accounting review, the accounting close call, all the modeling that goes into it, the actuals to budget, the dashboards, et cetera, like that 2,000 is going to be closer to 20,000.
Okay.
What this allows us to do is it uses the FP&A team as a foundation to create leverage and efficiency for the CFO services.
Okay.
Now, I know we're kind of running into a little bit of time here, so I'm just going to kind of talk about one, just like in accounting, like what is one of the most keys to success in a new accounting customer? It's that onboarding.
Yeah,
like
onboarding makes a huge difference.
The love that we give our customer in those first 30 to 90 days, that pretty much determines the lifetime value of that customer.
Yeah. And
so how do we get started? Because that's another, let's look at, I don't want to say a fear factor, but the resistance is like, I don't know where to start. I don't know, how do I start offering advisory services? Yeah. Just like in accounting, we created a process. In accounting, we've got the accounting onboarding, system integrations, chart of accounts, et cetera, cleanup, right? And then we set the cadence. Same thing here. We start with, we need the line in the sand, the annual operating plan. It doesn't matter if you come in May or January or September, we need an annual operating plan. And this is how we get started. Yes, I believe I did send this. Yes. So steps 1 through 5, quick and easy. It's like review that chart of account, because if that chart of account is off, your actuals are going to be off, your budget's going to be off. And so whatever we do, we want to have a succinct chart of account, because this is where the beauty of systems like G-Accon can come into play. 2, focus on the revenue. Start with cash basis, keep it nice and simple, build a revenue model by SKU over a 12-month period or over a 3, and then on to year 2 and 3. Now go down the P&L, COGS, OPEX, get those assumptions in there. Most COGS, chances are, tends to be variable or incremental, right? Especially in our business, like if we hire a manager, you're going to go from 0 to 100,000, in one shot, right? Versus if you're selling in e-commerce, your revenue and your cost of goods sold tends to be a little bit more linear. Mm-hmm. Once you get your P&L done, let's focus on the balance sheet. Now, Ryan's not going to really jump into the balance sheet demo because it takes a little bit more. It's actually a lot more work. But what are the things on the balance sheet? And you can keep that simple too. You can use days outstanding, how you receive cash, your payable. So you can keep it simple, or you can get a little more detailed, especially if you have a lot of accruals, interest, accrued, all that jazz, prepaids. Mm-hmm. And then the 5th piece is you take the P&L you just created and you roll that forward 12 months. So you create these templates, because when you have your ops call, you're bringing in the actuals and you're bringing in the information you got from your finance call, and you roll that plan out another month. So, final thoughts before Ryan jumps on. I know Ryan's excited. My final thoughts are like the team. The team has to be ready for this. And don't try to make your team into something they're not. if you are successful and you have deep customer relationships and you're looking to scale, start thinking about you may need a different type of employee, different capabilities.
Mm-hmm.
Technology. I cannot emphasize enough. The technology piece is what really allows us to create leverage and efficiency and be able to have what I believe we offer, affordable advisory services. And then that last piece, the cadence and the scope. The cadence is keeping this a repeatable process, keeping it consistent so that every time you get on that call, just like on the accounting, the first thing my team does is, okay, here are uncategorized that you did not provide us information with.
Right.
2, here's your month-over-month P&L for the last year to date. There's choppiness and variance. Can we dig into some of those categories? Just like we do in accounting, we need that cadence so that it's repeatable, consistent. You're training the customer to show up and know what to expect.
That's important. I know some other speakers have mentioned that too. Like when it comes to training the client, it's not always that mentality of whatever the client says goes, right? Sometimes we have to gently nudge them into the process. And it does become kind of like training them, kind of getting them ready for what they're going to need to do, because also some of this is going to require work from them and they need to be prepared for that as well.
Yeah, agreed. Ryan, if you want to jump on, Cody just asked a great question. I'm just going to answer this question. So Cody, when I started, like I said, it was just me, myself, and I'd be doing the business development by the evening. I'd be doing customer work by the, burning the midnight oil, and then in the morning meeting with the customer, right? That is not scalable. So Cody, like the first step in scaling when you're starting off small is you hire an analyst, and hopefully you're hiring an analyst that can navigate spreadsheets, can navigate, understands, doesn't have to be super proficient gap accrual, but it needs to be able to build out at least cash basis forecasts. Once it's you and an analyst, now you can bring on another analyst, and hopefully that first analyst you brought in, just like Ryan 4 years ago, came in as an analyst, and yes, he had a baseline in accounting, but he didn't have like deep finance modeling experience. 4 years later, he's running a team of 3. And so there's actually, like, you can actually optimize how many people and their respective salaries. And I believe that a team of 3, and Ryan can yell at me for this, I actually think a team of 3 can easily manage 30 to 40 customers. Because you start looking at, Cody, you start looking at like blocks of time, that's capacity at the people level. Mm-hmm. You start creating these blocks of time. The person who's actually having the meeting with the customer doesn't need to spend 10 hours preparing for that meeting. They're only spending 1 hour during the call and 30 minutes to 60 minutes preparing for it and coming out of it. Whereas the junior analyst is probably spending 8 hours preparing for that call. But the junior analyst makes half of what the senior does and probably makes a quarter of what a CFO makes. And that's how you create the leverage. All right, Ryan, I think I burnt through. I did too much talking, so I'm going to go on mute.
You're fine. Don't worry. We're okay.
Totally fine. Thanks, Dan. Here's my screen. Apologies for clicking, but if you can hear that. So when you enter into a new Google Sheets, the first thing you want to do is obviously add the G-Accon extension. So if we come over here into extensions, I already have it loaded up, but it'll probably be down here. First, obviously, you'll sign in, connect to QuickBooks, and then it'll come down here to the Get Accounting Data / Reports. In this version, I'm using the custom accounting reports to pull in the three big ones: P&L, balance sheet, and cash flow. And I'll show all of you those in a second here. But it's really easy. They have a ton of reports, so it's not just the three main ones, a lot of different ones. And if you use the budget feature in QuickBooks, you can use that here as well. And the classes, location, everything we know and love from QuickBooks can be synced in here in Google Sheets. And so once you pick a report, you can pick the dynamic range with previous months, a ton of settings. You can also make automations to make this pull multiple times a week, daily, weekly, monthly, even hourly. And if there's multi-currency, you can do that as well. And then you would press execute down here. I already have it set up. So this is the P&L, how it comes in through G-Accon from QuickBooks. But this is not where we're doing all of the work. So like Dan mentioned, our three sets of numbers, the AOP and the rolling forecast, we have separately from this sheet. And what I'm basically doing is just having some H lookups and V lookups mapped here to pull the data forward. So we'll start with checking out the balance sheet really quick. This is how it is presented, and then the cash flow. So all from QuickBooks. So this is a really simple demo. There's only revenue and some expenses. There's no COGS or anything in this version. But we'll start with the AOP. So the budget, this is hard-coded and locked. This is what we work on from hopefully October till and lock it in before Thanksgiving. So right around now. But sometimes there's stragglers and we get them in December / early January. But this is the plan. This is locked in. This is not going to change. And then we have our rolling forecast. This is where we connect to the actuals that flow in from QuickBooks. So all of these formulas, they even bring the links through. So if people have questions during our finance calls or ops calls, we can really dig in if needed. So that's how I connect it. I do a couple small steps with a reference tab. Go ahead, Kelly.
So just to point out, right? So this stuff comes in from QuickBooks, you connect it, and then everything pulls in and refreshes on whatever schedule you set it up on. But I think I want to point out that you really only have to do that once, right? So once you get it to where you want it to look like, what you want it to be, the schedule that it's on, etc., you're just having to do that once. And then so for you guys, when you're going on these calls, you're having these calls with clients, you're just essentially able to refresh the data and then pull into the reports that you want to discuss with the client. Does that make sense?
Correct. Yes. Once the schedule is updated, unless things change from the accountant, like Dan mentioned, new chart of accounts,
right,
all of that will sync in and it will, trigger
populate
us.
where it's supposed to be.
Yes, exactly. It'll be
I
a
just
red
don't want it
flag.
to be intimidating. So anyone that's watching, you really just have to, you set it up the one time and, maybe some fixes here and there, but for the most part, you're all set.
Yeah. So as the months come in, so eventually November will come in, say December 1st. Obviously, the numbers won't be, fully updated from the accountant, but that's okay. Once that accounting close call is, that's when we really come in to massage everything in here. So I will go over to the variance analysis. So this is set up similarly where we're connected to the QuickBooks P&L slide and to the AOP, which is locked. So in this case, I put in some pretty strong numbers for revenue goals etc. So all of this, we have conditional formatting in here to put up a red flag when things aren't, are very below budget. So these are the things that we would talk about during the finance call and think of risks, opportunities for the future. And then once we're all set with that in the finance call, that's when we come back to the rolling forecast and we'll work on November's numbers. So here I changed up the numbers. So it's very different from the budget. So the budget I have, we were hoping for 100,000 per month. That obviously isn't happening. So our rolling forecast is going to be much different. So in this, the actuals in October are only $91. So I threw in some more expenses on the social media advertising to hopefully bring up some revenue starting at 1,000.
And that's part of the advisory services, like
correct.
Not just saying, here are your numbers, you need to make more money, good luck. It's more, hey, I think we could, increase, in this case, advertising, or look at maybe getting a specialist for something, or let's see where we can move your money around to make it help you more, I'm assuming.
Yes, definitely. Because we don't just take into account the P&L here. We also look at the cash flow and what's actually happening. So this month, we're burning some money. Obviously, in this version, isn't showing that, but that's what we would take into account and say, all right, here's where we're at. Here's where we want to be with the budget. What can we really do to move the needle, even if it's to take one step forward?
Yeah. Very cool. And then what is your reference sheet? Just because you didn't click on that one, is that tying everything together?
Yep. So my reference sheet is basically the chart of accounts and which line in the QuickBooks P&L it's looking at. It's for the V lookup and H lookups.
Got it.
That way, the only thing we really need to change is in the QuickBooks P&L. The only thing I add is the matching dates to my rolling forecast, and then on the side here, which row.
Got it. Just tying it all together.
That way it ties. It knows, the formula knows where to map everything and pull the one cell that it needs to look at between the date and the row here.
Got it. Awesome. Very cool.
Yeah, the key here is this can be a tedious manual process without that integration, being able to pull the actuals into your budgets and your monthly updated forecasts. Now, Ryan didn't actually build out the dashboards or reporting, right? But everybody's going to have their own flavor of how they want to slice and dice things.
Right.
What Ryan's really trying to lean into here is you can reduce what would normally take anywhere between 1 and 5 hours. And why is there such a variance? Because you can spend 5 hours looking for that damn needle in a haystack.
Right. Or even just pulling in all the data to be able to put this together, export every sheet, then tie them all back together. I think the genius part of G-Accon is that you're able to do that in minutes, essentially. It's just, and that's why I said it's so important to say that once it's set up, you're not having to come in every month and pull down all of these reports and start all over again. You're able to just click essentially update and have it filter through all of that for you, which is an obscene amount of time saved.
Yeah. Ryan, our customer onboarding is what, 60 or 90 days?
I would say in the realm of 6 to 8 weeks.
6 to 8 weeks.
Pretty close. Yeah.
So you have the team essentially has 6 to 8 weeks to take what is like a GrowthLab template. Mm-hmm. But we're industry agnostic. So Ryan could be working on $100 million e-commerce shop one day, and the next day working on a digital marketing agency. Right? Very different drivers of the business in those businesses. So we don't create rigid templates, but we've got that 8-week window as part of the onboarding. What is the customer? Because the customer's they don't care about the sausage making.
Right.
Especially when it's fixed price, they don't really care if you spend 10 hours looking for a needle in a haystack.
Right.
What they care about is the output of the meetings, right?
Right. The results. I mean, I feel like that's what most people care about. Yeah, they're not always worried about how you got there, just so long as you got them what they were looking for and you made it something. I think also making it something digestible is important.
Well, Angela says it's a game changer, right?
Yes, I saw that. Thank you, Angela. Is there a reason or what brought you to, I guess, how are you using G-Accon? Well, I feel like we kind of already covered this, but I had it in my notes. Like, why did you choose G-Accon to help you scale? I'm assuming because it makes this so simple, but there may have been another reason.
One of the reasons we use G-Accon is when customers are price sensitive, G-Accon allows for us to at least have the basic automation that makes our lives easier. One. Two, in the world of startups, and I don't see this as much in like small, medium-sized business, but in the world of startups, it's not uncommon to have advisors and board members who are just way too deep into the spreadsheets that they don't want other dashboard tools. Mm-hmm. They want to be able to do their own tweaking. And so for us, it's like,
it translates easily.
It does. They know how to use a spreadsheet.
It's their language, yeah.
They live in the spreadsheet, and it works for them.
Yeah.
And they can't break it, right? That's the other thing. You can't break it.
Okay. Well, yeah, I was going to say, I think it's the time saved. I didn't think of it, but you're right. The easy, I guess, exchange with the team on the other side. So not always just the business owner. You could have board members. You could have maybe a CFO, whoever you're dealing with on their side. Essentially, Google Sheets, spreadsheets, etc. Speak to. I want to say it's almost like a universal language. They speak to everybody.
They can't get out of their spreadsheets.
Right.
So it's a solid tool. It gives us what we need, the efficiencies. It allows us to stay within scope, keeps our margins in a good place, and we're not, like, our team members are not spending valuable time on non-value added tasks.
Yeah. One more question, because we only have a couple minutes, but what are some of the mistakes maybe that you made or that you see other firms making when they're trying to move from compliance to advisory and kind of pulling some of these tools in? I know one of mine was maybe using too many tools, like, oh my gosh, shiny object syndrome. I'm like, I want to sign up for all the apps and do all the things, and it gets to be too much. But what are some of the things that maybe you went through or you saw, or maybe just words of wisdom?
I think as the conversation we had in the first part of this webinar, training the customer, getting them to a place where getting their attention consistently, staying on the rails, kind of, that has always been the hardest part. I will tell you though, one thing I will never forget, and this was probably back in 2018, we lost a customer because of that shiny new thing. We were trying to get that customer to use one of the dashboard planning platforms. They didn't want it. They wanted spreadsheets. And we dug our heels in, and from that day forward, like, I get it. We're only going to be able to change so much behavior. So giving the customer what they want, and because the onus of managing and maximizing our gross margin in a fixed price service model, the onus of the gross margin falls on us. I can't just charge you an extra hour because I spent an extra hour. And so that really forces us to be innovators in a service-based business.
Yeah, I agree. So we are at time. Thank you both so much. Thank you to G-Accon for essentially hosting and sponsoring this webinar. I know that some of you have reached out in the chat. You'll also get a follow-up email with information on the recording, and but somebody did put the slide link in the chat if you guys want to grab them. But thank you both so much.
Yeah, it was nice seeing you, Kelly, and thank you, Ryan. Great job.
Thank you.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.